Hello there. This is Tejas from Trendline, and in this video, we'll talk about three growth companies that beat the average consensus forecaster estimates, both in terms of revenue and net profit in Q1 FY23. As inflation climbed and interest rates rose, we look at companies that weathered the changing environment well and are poised for growth despite headwinds thanks to advantages in their business model or industry. These companies also posted higher year-on-year revenue growth than their sector's average revenue growth and are expected to see strong top-line growth in Q2 FY23 as well, according to forecaster estimates. The three growth companies in focus are Tata Chemicals, Asian Paints, and Bajaj Finance. All three companies' stock price outperformed their respective sectors and the Nifty 50 over the past month. Tata Chemicals stock is up nearly 30% and outperformed its sector by a staggering 17%. And Bajaj Finance's stock rose close to 27%, outperforming its sector by 14% in the past month. Tata Chemicals, which is a commodity chemical manufacturer, made it to the list as its revenue beat Trendline's forecasted estimates and rose 34% year on year. Its net profit jumped over 2 times due to high realization from its basic chemistry products, especially soda ash. According to forecaster estimates, its Q2 FY23 revenue is expected to rise 42% year on year. Coming to Asian Paints, strong demand in its decorative business helped the company to post a year-on-year revenue growth higher than its sector average in Q1. Revenue rose 54% and the net profit jumped 79% year-on-year due to steep price increases and healthy volume growth. The paint maker is expected to post 25% year-on-year revenue growth in Q2 according to forecaster estimates. With such strong prospects, its share price outperformed its sector and rose around 18% in the past month. Finally, Bajaj Finance beat the net profit and consensus estimates by 8% in Q1 FY23. Its revenue rose 37% year on year against its sector average of 6.4%, and its net profit was up over 2 times on the back of an increase in net interest margin with improved asset quality. This non-banking financial company or NBFC is expected to clock a 27% revenue growth in year on year in Q2 FY23, continuing its growth momentum according to Trendline's forecaster estimates. We will now dive deeper into each of these companies and understand what helped them post better Q1 results than Trendline's forecaster estimates. We'll also look at why analysts expect them to grow at a fast clip in Q2. Let's start with Tata Chemicals. Strong demand for basic chemistry products manufactured by Tata Chemicals helped the company post revenue growth of 34% year on year in Q1. In fact, the revenue is rising year on year for the past 6 quarters. Its net profit jumped over 2 times year on year on the back of higher realization, mainly in its soda ash product despite an increase in input costs. With consistent revenue and profit growth, Tata Chemicals has a high trendline durability and valuation score. The stock also has a good momentum score. It hit a 52-week high on August 12th. Trendline forecasters consensus analyst rating for this stock is buy. This chemical manufacturer beat forecasters consensus revenue and net profit estimates in Q1 FY23. While it beat revenue estimates marginally by 2.5%, its net profit beat the consensus estimates by 44%. The positive surprise in net profit was mainly driven by higher than expected realization in its basic chemistry segment. In Q2 FY23, forecaster estimates show that revenue is expected to grow 42%. This is on the back of sustained traction across all products and regions. The chemical manufacturer derives about 75% of its revenue from basic chemical products and the remaining 25% from specialty chemicals. Under basic chemicals, Tata Chemicals offers soda ash, sodium bicarbonate, cement, salt, marine chemicals, and crushed refined soda. The specialty chemical segment consists of products that provide solutions for agrochemicals through its arm, Rallis India. The basic chemical revenue rose year on year across all regions, India, North America, Europe, and Africa. Overall revenue from this segment rose 37% year on year. Revenue from India and North America rose 46% and 34% year on year, mainly due to a revival in the demand for its core products, namely soda ash and sodium bicarbonate. Realization per ton in the basic chemistry segment rose sharply year on year on the back of strong demand for its core products. In Q1 FY23, soda ash prices rose 34% compared to the same quarter previous year. Even though the prices cooled down in the past month, falling 9%, they're still up 20% in the past year as of August 18th. High soda ash prices and strong demand for Tata Chemicals core products helped the company's operating profit margin to rise across all regions. Among the major revenue contributors by region, India and US businesses margins rose over 300 basis points. According to brokerages like ICICI Direct and Motilal Oswal, strong revenue and net profit growth is expected to continue in Q2 FY23. However, volatile end product prices could hurt margins going forward. The second stock we are looking at is the leading paint manufacturer in India, Asian Paints. This company posted a strong set of results in Q1 FY23, topping analyst expectations. Its revenue and net profit beat the consensus forecaster estimates by over 10%. This welcome surprise helped the paint maker stock to rise over 18% in the past month. In Q2 FY23, revenue is expected to rise 25% year on year according to Trendlyne's forecaster estimates. Steep price increases to combat price inflation in raw materials and healthy volume growth helped Asian Paints post a 54% year-on-year revenue growth and 79% net profit growth in Q1 FY23. The company's revenue is on uptrend for the past 7 quarters. A high year-on-year volume growth of 37% in the decorative business helped the company's revenue rise by 54% in Q1. According to the management, volumes grew on the back of strong demand from Tier 2 and Tier 3 cities, new dealer additions, and new product launches. Asian Paints added 5,000 new retail touchpoints and launched 10 new products in Q1. The management is confident of double-digit volume growth in FY23. New products are an important moat for Asian Paints and has helped the company increase its market share. The home decor business includes the kitchen and bath segments. Bath business in particular rose over 2 times in Q1 FY23. This growth momentum could continue in Q2 with the opening of a new plant in Q2 FY23 at Pune for this segment. The operating profit margin rose 170 basis points year on year in Q1 FY23 mainly due to operating leverage. Management expects the metric to rise if inflation eases with lower crude oil prices. Brokerages like ICICI Direct and Prabhudas Lilladher have a positive outlook on the stock. This is due to a decline in raw material prices in the past few weeks, calibrated price hikes, and increased demand in the home decor and waterproofing business. However, investors should note that the stock's price to earnings ratio is quite high. It is at 97 as of August 18th. This PE number is higher than its 3-year and 5-year PE, which puts it in the sell zone, with the company stock trading below its current PE 94% of the time. The final stock in our growth stock list is Bajaj Finance, a non-banking financial company or NBFC. Bajaj Finance has been a popular pick in the past for investors and analysts. Since mid-2018, the stock has risen steadily and delivered stellar results between May 2020 and September 2021. In recent months, however, the stock turned volatile over growth concerns. So investors were pleasantly surprised with Bajaj Finance's Q1 FY23 results. Its net profit beat the consensus estimates by 8.2%, and analysts expect its net profit to rise over 50% in FY23. As a result, the stock jumped 10.6% post its result announcement on July 28th. Revenue and net profit are on the rise since Q1 FY22. Rising assets under management or AUM coupled with improving asset quality mix led to strong revenue and profit growth in Q1 FY23. The NBFC's revenue rose 37% year on year while its net profit jumped over 2.5 times in Q1. With such strong financials, Bajaj Finance has a high trendline durability score. Bajaj Finance's AUM has been growing consistently for the past 5 quarters. In Q1 FY23, AUM grew 28% year on year with new loans booked rising 60% year on year. However, in the Q1 earnings call, the management said that it will prioritize margins over loan growth. High growth rates in crucial segments helped Bajaj Finance's AUM to rise in Q1 FY23. The rise in AUM was mainly contributed by mortgages. This segment constitutes around 23% of AUM mix and it rose by 28% year on year in Q1 FY23. Small to medium enterprise AUM also witnessed a healthy growth. Auto finance AUM, which constitutes 5% of the total AUM, fell 12% year on year. However, the management expects a recovery in this business segment in Q2 FY23. A sharp year-on-year decline in gross and net non-performing assets shows asset quality improving in Q1 FY23. Non-performing asset ratios are currently below the pre-COVID levels. The management expects a further reduction in NPA in the next 2 quarters. The net interest margin also rose both year-on-year and quarter-on-quarter as the company passed on RBI's rate hikes to customers. In Q1 FY23, NIM rose 170 basis points year-on-year to 13.2%. However, a brokerage report from Motilal Oswal estimates that NIMs will contract 40 basis points in FY23. This is due to the company's limited ability to pass on the increase in borrowing costs against its large fixed rate loan book. So in this video, we looked into 3 growth stocks that have outperformed both the Nifty 50 and their sectors in the past month in terms of share price. You can find more information about these companies and other listed companies on trendlyne.com. This is Tejas signing off.